Imagine building a portfolio today that you could literally forget about, yet you could watch it grow for decades. No stress, no constant trading, just a simple portfolio that is going to work around the clock for you. And in today's video, we're going to be breaking down the top 5 ETFs to buy and hold forever to build this portfolio. Funds will give you instant diversification, steady growth, exposure to the biggest wealth trends that we see within the US markets. If you want financial freedom without the complicated strategies, and really looking at ETFs, they are the cornerstone to this portfolio. So let's dive in. When we think of ETFs, they are the building block when it comes to building a portfolio that you don't have to trade, you don't have to worry about. Just making those consistent contributions are going to build the portfolio. Now, the foundation for this portfolio is going to be the VOO, or that S&P 500 fund. Now, this is a large blend fund, and it is tracking that S&P 500 index, has an incredible low expense ratio of a 0.03. This is the foundation when it comes to ETFs. Now, there's a lot of variations that track this exact same index. Me personally, that I hold in my portfolio, I do hold the VOO, and I do hold it in a multitude of portfolios to track that S&P 500. Now, when it comes to this ETF specifically, it is invested into 500 of the largest companies within the United States. Does have a really good year-to-date return, 10.5% as of 8/15. So doing incredibly well so far this year. And when we start looking at the rating, the risk and the reward scale is a 4. Now, this is something to remember, depending on where you're investing and depending what ETF, this risk reward scale could really change. But this is the S&P 500. When we think of famous investor Warren Buffett, he says that everyone should hold the S&P 500. Even looking at my personal portfolio through dollar cost averaging, over the last 4 years, we have seen a 100% return within this S&P 500 fund. Looking at the performance and going back even further, this is where the numbers really get interesting, and this is where you have to pay attention. When we look at a 3-month total, we're at 14%. So again, this year has been doing incredibly well. Year to date, we're at 8.5, but then we look back 1 year, we are at 16%. Now, traditionally, the S&P 500 grows about 10%. So to see a 1-year average of that 16.32% is doing phenomenal. Now, a lot of this is also driven by the heavy tech focus, and you'll see that as we look at some of these other ETFs within the portfolio. But then we look at the 3-year, even running at 17%, then even going further back to the 5-year, which is running at 15.85%. It is incredible the performance we're seeing out of this VOO. And again, when we even go back further than the 10 years at 13.6, it is still doing incredibly well since inception, 2010. So you're talking over a 15-year period. We have seen a 14.63% growth. That is incredible. When you start looking at that number, guys, we're almost to 15%. And I know there is a heavier tech portion because of how it is market weight capped, meaning that the larger the company is, the more weight it's going to carry within the S&P 500. With it being invested into all the different sectors, you still have a lot of diversification. If you went in and if there was one single ETF that I would invest in, if I only had to choose one, I would invest in the VOO for the extended amount of time. Now, for the price, like we said, it is a 0.03. Vanguard funds historically are very cheap when it comes to the expense ratios, even looking at similar funds at a 0.75. So it is much lower. Now, one thing to note, S&P index, the beta is 1, meaning how close does it actually track the market? This is spot on. When we think of the S&P 500, when we think of this fund, it tracks the market just perfectly, which is kind of by design. The price is going to fluctuate, not too worried about that. But then I want to get into the portfolio. This is where it gets interesting because the VOO is at 504. This is a large blend. Now, one thing to note with this is even though we're seeing that 15% return, it is not a very large growth, which we see a lot heavier into tech. It also isn't the value side. We are right in the middle with that blend. P/E ratios even a little bit high at 27x, but you can see the market cap on this 351 billion. So it is incredibly large. Then we look at the breakup. This is kind of the part I want to pay attention to because when you start thinking of the technology side, it is 34%. Now, for a tech ETF, that is pretty low in comparison to something like a QQQ, which is very heavy in the tech sector. But again, with this, you have a lot of diversification, 13.6% in financials, consumer discretionary and communication services make up another 20%. So when you think bigger picture in here, even though a lot of it does have that information technology side, it is kind of weighted by the rest of this being and giving you some exposure in a lot of different sectors with the VOO, which is the reason why I do hold this. Now, this also does pay a very low yield or a very low dividend overall, not really holding it for the dividend, but looking at the companies, when you look at Nvidia, Microsoft, Apple, Amazon, Facebook, they are the biggest names. They are by far the biggest names that we have within the United States. And even when you look at all of these companies, and the reason why I don't really invest in global companies is all of these companies are global companies. When you think they might be US based, they're on the S&P 500. They are companies that are essentially trading on our exchange. They are global companies. There's a point where technology got so big that they are in every single country within the world, which is kind of crazy to think of the global expansion. But overall, investing in the market makes up roughly, and the US does, about 50% of the market. Then we look at the VTI. Now, this varies a little bit different than we've seen with the VOO. So with the VTI, this is the total stock market. So this is casting a much larger umbrella. This includes all of your mid cap stocks. It also includes all of your small cap stocks. Now, even when we think of large cap makes up about 80%, the other 20% is those mid and those large cap. And again, this is weighted the exact same way. It is weighted by the size of the company or the valuation of the company. So it is market weighted cap. Expense ratio remains the same at the 0.03. Then we get into the performance. So 9.91, so doing pretty well year to date. But I want to get in and break it down a little bit further because this kind of shows you more of a snapshot. The 3 month is running at the 14.3. Year to date, we're at 8%. So it is underperforming the VOO. Even looking at a 1 year, 3 year at 16, 5 year at 15, the 10 year and the exception since 2001. So thinking about 9 years earlier since this one was created, running about 9%. So when we kind of look at the 10 year at the 12.97, and then we also do look at the performance in here, the VOO is outperforming at 13.62 versus the 12.97 on the 10 year. So you would get a little bit more growth out of those large cap stocks. Again, a lot of this is driven by semiconductors. A lot of it is driven by artificial intelligence and all these companies that are making a valuation for the company itself. So when you think of the diversification of the VOO, then you compare it to the VTI. The VTI has a much broader range because you are invested into a lot more companies, which gives you, again, a little bit more exposure into those mid caps and those small caps. So in here, still large blend. Again, when we think of the VOO and those 504 companies, the VTI is 3,526 companies. That really goes to show when it comes to those mid caps, when it comes to those small caps, they do hold a lot of weight. Now, historically, mid caps usually do overperform, or they do exceptionally well in conjunction to like a large cap fund. The reason being a lot of those smaller companies that are not quite large enough to go in the S&P 500 perform exceptionally well. These are kind of the backbone of America. When you start thinking again about the 3,000 companies in here, or the 3,000 plus companies that are not included in the VOO, you can definitely see if you invested into something like this, you are including in the US market itself and investing into every single company that is publicly traded in the United States. So again, this is one where if you wanted to put some money in here, if you wanted to get a little bit more diversification, you could absolutely do it. But again, if I had to choose one ETF and only one, I would invest in the larger companies within that VOO. Then we get into the SCHD. Now, this is one which is the Charles Schwab US Dividend Equity ETF. Expense ratio, double what we've seen of the two Vanguards, but this has a very, very different methodology behind it. This one is the dividend producer. When we think of the VOO and the VTI, one, and really choosing one of those is going to be, and they are going to be your foundation. They are going to be the base. They're going to be the building block when it comes to a portfolio. Now, the SCHD is going to be the income. This is based on the Dow Jones US Dividend 100. So this tracks, again, a very limited number of companies, but You don't see as high highs, you don't see as low lows when it comes to something like the SCHD, and you'll see that as soon as we get down to the performance. Now, one thing to note with this, it is the income generator. When it comes to the dividends, the dividend in the dividend yield and the total growth is exactly why people do buy this, because we have an SEC yield right here of 3.79. When you look at the VOO, when you look at the VTI, they run less than 1% when it comes to the yield. So looking at this with the SCHD, you're getting a 3.79 return, which is pretty good. That is almost a 4% return. You do see a little bit of growth out of this one. You do see the dividends, and the overall or the total growth that we see within this ETF does incredibly well. Now, unfortunately, with the performance, this is when it kind of changes up a little bit, because you can see that looking at a 3 month, we're at 3.65. Then we look at a 1 year as of right now. And this is the reason why I had actually dropped the SCHD out of the portfolio. The 1 year, we are at 1%, even the 3 year at 6, the 5 year, the 10 year. So even looking at the last decade that we've seen within here, overall, the growth of this fund has underperformed when you look in conjunction to the VOO. And again, that is because it is very heavily driven over the last decade when it comes to those tech companies. Now, SCHD, in my opinion, has a really solid place in portfolios, but it's going to be very dependent on to one, what is your risk tolerance? Two, what kind of are you looking for? Are you looking for a return? Are you looking for getting cash? And that could be something to think about when you get a portfolio. And my idea and what I'm doing is investing right now in a lot more of the tech side, a lot more of the growth side. And then as I get closer to retirement, switching some of that growth that we've seen over the last 10 years into something like the SCHD, that we're going to see some growth. We're also going to see some income. The income that is generated in there can be a supplement to Social Security. And that is where we are going to essentially bridge the gap between getting Social Security and having some of these income producing ETFs, which do work incredibly well. Now, this again, you can build that 3 ETF portfolio. You're going to have your foundation, which is your VOO or that VTI. This one is going to hold in your kind of cash generation, your dividend yield. And again, this isn't going to have those very high highs that we see when it comes to the tech side, but you're also not going to have the really big pullbacks. Now, over the last 3 years, the market has performed exceptionally well. But again, this is something that is going to protect you when the market does pull back, because the SCHD is invested in a lot more of our blue chip companies and some of the very regular companies that pay dividends and have paid dividends for an incredible amount of time. When we start looking in here, you can see the worst and the best returns, but I want to break down kind of what companies are in. And when we look at the portfolio itself, you can see this is pretty good, because when you think of, breaking up the portfolio, giving a little bit more exposure to a couple other places, when we start looking at Chevron, Pepsi, Elrita, looking at Cisco, Home Depot, Merck, all of them, and a majority of them might be held, and some of those are in the VOO, in that VTI, but in here you have a much higher concentration. And you also notice a majority of the top holdings within this ETF are not tech companies. Tech companies traditionally do not pay and do not yield a very high dividend. So again, it's kind of geared towards and aimed towards two entirely different investors. But again, when you think of a well-rounded portfolio, you're going to have the foundation, you're going to have your growth, and you're going to have your income generation, which would be the SCHD. Then we get into one of my favorites, which is the QQQ. Now, this one I hold as 50% of my portfolio. We were talking about that big growth section that we were talking about, looking at growing a portfolio very high, very fast. That is exactly what the QQQ has been doing. And looking at the overview, total expense ratio of 0.2. Now, some people might take pause thinking of the 0.03 that we've seen with Vanguard, the 0.06 that we've seen with Charles Schwab. Now, this tracks the NASDAQ 100, but the total expense ratio, anything less than 0.5%, anything even less than 1%, is still good as long as the ETF is performing exceptionally well. And so far, the QQQ has been doing just that. When we look at the performance in here, look at this. 1 year, we're at 20%. 3 year is at an 82% return. 5 year is at 119%. Remember the rule of seven. If you're unfamiliar, the rule of seven says it should take 7 years essentially to build your portfolio, or to double the value of the portfolio. When we look at 10 years, we are at a 445% return, which is insane. This isn't going to happen every year, guys. Over the last 10 years, we have seen incredible market growth. We have seen the evaluation. We have seen the price of stocks, and even the cost basis, the cost ratio just go through the roof. I mean, if you're looking here in every 10 years, you are 4Xing your portfolio or over 4Xing. That is incredible. The growth in the market, the growth in the US market has been on fire. And like I said earlier, this is the growth ETF that I focus on. And this is the focus that I have 50% of my portfolio on. Because then when we get into the holdings, so looking at the very heavy tech. Now, one thing you'll notice off the bat is when you look at the QQQ, NVIDIA, Microsoft, Apple, Amazon, Broadcom, all of those are going to be held in the VOO. They are also going to be held in the VTI, but it is not going to be at the same weight. So when you think of kind of doing the comparison of a VOO side by the QQQ is going to be much, much heavier focused into growth, much heavier focused into tech. And that's exactly what we're seeing here with those mega sized companies, is even though there is quite a bit of overlap, the VOO does contain a lot of stocks that are not held within the QQQ. And remember, this holds 100 stocks. The VOO holds those 500, and then that VTI holds those 3,500. So you can see kind of where, depending where you want to scale back, where you want to view this from, it can really make a big difference when you really and how you want to build this portfolio. But like I said, we have one part that is the foundation, one part which is the income generation, that SCHD, and then we have this part which is the growth section. Looking at the sector allocation, you can see, guys, 61%, almost 61% of this technology. Consumer discretionary makes up another 20%. That is, I mean, what, 80% of the entire portfolio just between those two sectors, which is huge. I mean, healthcare, industrial, telecommunications, you have a couple in here, but it's held in such a small amount. Really doesn't make a big difference on the portfolio because this is all focused in growth. Now, if you're looking for tech and just very tech specific, we look at the SMH. Now, this one is the Van Eck semiconductor ETF. Now, when we think again with that QQQ, a lot of it is focused into tech. There's some of that consumer discretionary. This is tech, and this is only tech. So depending, again, the allocation that you're looking for, the risk factor that you're really looking to take, this is focused on semiconductors, and this is focused on tech in its entirety. Looking at the performance, again, it is incredible because even going, 3 months, you're at 36%. Think about that for a minute, 36% growth, just because, again, the driving force that we see in tech. Year to date's at 19, even 1 year at 17. 3 years go to 35%, 5 years at the 29, and then of course 10 years at 28, lifetime 25.73, which is looking over the last 14 years. You're looking at a 25% annual return for the last 14 years. You want to talk about a portfolio that is just tech focused, that is going to be absolute fire when it comes to growth. And again, this is something that definitely holding a much higher weight at a much younger age. I mean, if you're 18, 20, maybe even 30, having a good majority into something like the QQQ or the SMH, the semiconductor fund, is going to give you, and you have a long runway to growth. When you even think about 65 years of age, so let's say, for instance, you're 25, you're going to 65, you have 40 years of growth. But you also have to remember is that when you hit age 65, it doesn't mean you're cashing everything out. It doesn't mean you're out of everything. You're out of the SMH. You're out of the QQQ. You're dropping the VOO and the VTI. No, it has been proven. There has been an incredible amount of studies. Yeah, you might want to get a little bit more conservative, maybe putting some more percentage into that SCHD, but you are not going to drop out of the tech. You are not going to drop out of the foundation ETFs when you get to retirement, because even at 65, chances are you might have another 20 or 30 years to live until you're completely done, to where this portfolio can grow at really just that 10x And thinking about someone again like Warren Buffett, at the age of 65, he had a good amount invested. By the time he was 65 up until 94, that is where and really the compounding takes effect. And a lot of people don't realize that. There is going to be a very large window during retirement that your portfolio needs to grow, even if it is a rule of four, the rule of 4.7, whatever it may be, your portfolio still has to grow and still needs to grow. When it comes to retirement, you can't throw it all in bonds, earn your 1.5% and be completely done. It still needs to grow, and it still needs to grow in a regular amount of time. So looking at a hypothetical $10,000 investment, so looking at the beginning when this was invested, your $10,000 investment would be now $224,000 since inception. Thinking of the growth, looking at 10 grand, guys. So think about that. In 14 years, your $10,000 of the investment turned to $224,000, and that's only $10,000. Imagine if you were dollar cost averaging into a portfolio like this and you were growing it and putting contributions in there, maybe once a week, maybe every 2 weeks when you get paid, maybe even once a month, and you grew this portfolio since, 14 years. If you were making contributions really into this portfolio for 14 years, this would be through the roof. If you had access to something in a 401k plan, which even looking at like the VTI, the SCHD, and the QQQ, I do not have access to any of them in my 401k plan as much as I would love to, as much as I would love to invest there. Unfortunately, I cannot because we're very limited. And a majority of people who have money going into like a target date fund, you will see, and you can actually compare your target date fund to the VOO, to the QQQ, to a majority of ETFs that you have within brokerage accounts. And you'll find out very quickly that those target date funds are underperforming, and they are underperforming by a significant amount. So overall, guys, when it comes to building out these portfolios, I absolutely love to show you 5 ETFs that you could literally buy. You could build a portfolio, again, kind of depending on your age, depending on the allocation, and you could really have a portfolio to grow forever. When you start looking and really breaking it out, so if you're younger, again, 20s, 30s, maybe even 40s, running 30, 40, even 50% into something that is going to grow, one of those really strong growths like the SMH or that QQQ really does make a big difference. Having something, and I know I am very more risk heavy, I guess. And some people say, hey, that's the way it needs to grow. Again, I still have 20 years till I retire. So we have a long runway with some of those growth ETFs. Having roughly 30% into something like a VOO or the VTI does make a big difference. Holding that final 20% in something like the SCHD. Now, I chose to go again a little bit more risk heavy in the portfolio, and I actually invest in Bitcoin ETF, which again, I feel like Bitcoin is going to be something in the future that is going to be a really big driving force when it comes to income generation and when it comes to really the gold standard that we're seeing within cryptocurrency. All right, guys, so that's going to do it for today's video. If you like the content that I'm throwing out there, definitely give it a like, subscribe to the channel, share it with someone else, and let me know what ETF of all 5 of these you invest in, and I'll catch you in the next video.